I feel that parts of multifamily, the better stuff that people really want to buy, which is like C+, B- and above, you're going to have it even be more expensive in the future because I feel it's a safe place for people to invest and hold their money, especially with this understated inflation that I think that's happening right now in the U.S.
This episode brought to you by Suites at Madison. Meeting and conference rooms for rent by the hour, week, month, or year. Suites at Madison, where business gets done. Check them out at www.downtowntampaoffice.com. Now, on to the show.
You are listening to the Invest Florida Real Estate Show, covering topics in lending, buy and sell strategies, property management, hot markets, and tips and tools to guide you along the way on your path to real estate success. You want Florida investment real estate talk? You have come to the right place. And now, our hosts, Eric Odum and Steven Silverman.
Hello, and welcome to another episode of the Invest Florida Real Estate Show. This is your co-host, Eric Odum, along with Steven Silverman. Steven, it's a new political world, new year. There's a lot of new stuff going on. Hopefully, because it's important to the economy, that we can get this COVID stuff straightened out. People are still bunkering down, and we don't want that to go on much longer. It's not good for business. It's not good for people. People are still scared, but I think we see the light at the end of the tunnel finally.
It's definitely happening. People have been sitting on the sidelines and thinking about investing or not wanting to do anything, and people weren't sure about selling, but the market's reacting very optimistically. Inventory's tight and people are doing deals.
Yeah, I mean, even office. I mean, we managed to find a good deal for a client last year. And, I think you just actually took a listing appointment on that. It's, people say, well, office is not going to come back, but that's just not true. I mean, there's interest in office. It's not as firm yet as in industrial, which is on fire. But you just showed somebody this space.
It was actually interesting. This was a deal we did on selling an office, and I got a call from someone, a broker, and he told me that, normally we talk about written reviews and on social media, but he said that, he listens to the podcast, he gets some good information from it, and he thanked me for that. And, we love to do deals and help people. They're out there getting information and doing deals.
Did you ask him to give us a written review, Steven?
I didn't. And on that subject, guys, written reviews really help us because we need to get good guests because that's what helps create the interest in the show and it benefits all of us. So if you can give us written reviews on social media, that's what people look at when we ask them to become on the show as guests, and we all benefit. So please do that.
Yeah, they want to see that people are paying attention. We work very hard to produce this show. We have to ask multiple people. Not everybody's got the time. And one of the things they do look at is the review section. They go on our social media and make sure that we're active, and they're going to invest their time properly with us. Everybody's time is an investment. We can't get it back. So if you haven't done so already, please go to the iTunes store and leave a review, or even go to Facebook and leave us a review there. It definitely helps us. But, today, hey, we've got a great guest today, Steven. We're talking multifamily again.
We really do. He's got really great experience, and he thinks strategically about how to really do business. So I'm looking forward to today's show.
Well, let's go ahead and roll into our guest.
Today we have with us Charles Carillo. Charles is the managing partner of Harborside Partners, a real estate syndication firm based in St. Petersburg, Florida. He has been actively investing in multifamily real estate since 2006. Charles also hosts the Global Investors Podcast, where he interviews professionals about investing in U.S. real estate. Charles, welcome to the Invest Florida Show.
Thank you so much for having me on. It's a pleasure.
Charles, really appreciate you investing the time with us today. Why don't you give our listeners a 30,000-foot overview of how you got into business and why multifamily, and we can go from there.
Yeah, so I got started in multifamily real estate. My dad kind of pushed me into it. He'd been investing in multifamily and commercial since the 80s in central Connecticut, where I'm originally from. And I moved to Florida in 2012. And I started buying multifamily, smaller multifamily in 2006. I managed it for myself for 6 years and started off with just 3-unit properties and some 5-unit properties, and kind of went up into commercial properties, mixed use. So mainly was residential, and then with some small storefront or small office underneath them. And I self-managed them for 6 years. And 2012, when I moved to Florida, I was forced to go into third-party management on those, which I had never done before. And it was great because it allowed me to start scaling my business. And in 2016, I started going through and starting working with syndications. And that's kind of what we've been doing for the last few years. And most of our assets now, or door-wise, I guess you would say, is in Florida. But I still have a small portfolio in Connecticut, and we have one asset we're part of in Phoenix.
What areas of Florida are you focused around the St. Petersburg area, or do you have other parts of Florida that you invest in?
So we are mainly invested in Tampa and North Tampa areas over by up by USF, I should say. And a couple other areas in Florida we like is Jacksonville. We also like straight across the state over in Brevard County area, north of Palm Beach area, up the East Coast a little bit. The Southeast always gets a little expensive for my taste. So it's really a few different markets where we see growth is happening. And we definitely syndicate properties, and our kind of goal there is 75 plus units, $5 million plus purchase prices. And what we also do is we do some direct mailing in 3 counties in Florida: Pinellas, Hillsborough, and Brevard County, for 5+ multifamily. And that's something we've been doing for a year plus now, with where we're kind of looking for smaller multifamily stuff that we'll buy ourselves, or maybe joint venture with a partner or two.
Gotcha. So why don't we talk a little bit about the state? Because obviously you're very dedicated to working in the state of Florida. What are you seeing around the state in terms of cap rates? What's areas? You already pointed out some of the areas that work for you, but if there's anything else that you're sort of seeing out there that might be affecting the market, not only today but going forward?
Well, as you guys know, we're having such growth in, Tampa, but in many parts of Florida, and coming from the great exodus from the Northeast, and it's just pushing prices. And there's so many people. I speak to someone every day, and that's looking to invest in Florida in one way or another. And I'm not a commercial broker or anything like this, so they're not calling me looking for deals. They're just talking to me about it, and that they're not even relocated down here. They're just looking to invest into more landlord-friendly states, which is exactly what we're looking for, and exactly what we are in Florida. Is very pro-business, very pro-landlord, and we stand behind our landlords, also our tenants. But it's it's very friendly for business down here, and I think I know myself leaving Connecticut years back, and the problems I have there don't even exist here in Florida when just dealing with tenants. And it's just what you have to do when you're in certain states. And I think people are just getting sick of that, or when they're expanding their portfolios, they're trying to find places that are just more, that treat them better. And I think Florida is definitely a place for that. But there's so much growth coming in our major metros like Orlando, Miami, Jacksonville. There's so much, and there's a lot of international money that comes in too, which even pushes up prices and compresses cap rates. And as I'm told now, and as we look at everything, we might have more of a compression on that, which I'm not sure. I think certain asset classes will, and I feel that parts of multifamily will as well. The better stuff that people really want to buy, which is like C+, B- and above, you're going to have it even be more expensive in the future, because I feel it's a safe place for people to invest and hold their money, especially with this understated inflation that I think that's happening right now in the U.S.
So as you go about and you talk to these various people, are they surprised that inventory is so tight in Florida? Because we get those calls also where people say, "Oh, I'm ready to invest in multifamily," and they don't realize how hard you have to work to find a property.
They think it's like a single family home. Yeah. Like show me the listings. It's like, dude, what rock are you living under?
But they just don't get it, and there's really an understanding that has to happen, and then there's the sticker shock with cap rates. What kind of cap rates are you seeing that people are willing to pay?
Well, I think people get this unreal kind of idea of real estate and multifamily because up in the Northeast, there's tons of small multifamily and all price points. You can be in D class, and you can be, in the outskirts. You can be in Boston and have multifamily that's 120 years old that's been done over as B plus or A minus class. So people think, oh, I drive down the street and where my properties are in Central Connecticut, the city I'm in. I mean, you drive down the street and there's a duplex, triplex, quad, 10 unit. You know what I mean? And a lot of small multifamily, which isn't really the deal in Florida. And especially if you're trying to get that residential financing 1 to 40 unit, it's just not a thing. I mean, it just comes on and it goes off, and it just disappears, right? I mean, it comes on and goes off, and you really, because everybody wants to do the house hacking, it's so popular now, and all this stuff. And so anybody that's there's just not that much inventory down in Florida, and not even the amount of properties down here, even if they were up for sale in that small multifamily. And then on the larger end of it, it's very difficult to get into commercial brokers that are actually going to take you seriously if you don't have assets that you've closed in Florida or in the nearby area, which makes perfect sense. I mean, you're paid on performance. I don't doubt that one bit. That's why partnering with someone that has a relationship that you can kind of piggyback on makes it so important. It's very difficult just to, hey, I'm in Indianapolis and I'd love to buy in Florida, and I bought some stuff up here and I'd love to buy some stuff down there, and you don't really take it seriously. You know what I mean?
Right.
So how are the cap rates? Like you mentioned Connecticut coming in compared to something in Florida.
So Central Connecticut is going to have, it's a much more cash flow market, and you're going to have 7, 8, I wouldn't say 8%. The stuff that we're investing is probably 7% currently cap rates. And that same property would probably be 6%, maybe in the mid 5s in Florida. Wow. And so an older, smaller residential property. And there's just, I think that with those cap rates, you're able to cash flow up north. And it's even probably tighter down here, too, with how fast properties go off the market. Every time I check, they're always getting tighter and tighter. Yeah, I mean, it's just that up there, people have also unreal cap rate expectations because they feel, oh, down here is a better place to invest. But they also don't understand that there's a lot that goes with it. There's going to be a lot more appreciation. I mean, the population in Connecticut hasn't really changed in 30 years. And in the city I've invested with, it hasn't changed either, maybe 1% or 2%. And that's not kind of where you want to be if you're looking for any type of appreciation for when you're investing in real estate. You kind of want to see that job growth, you want to see the population growth, and you want to see a decrease in crime and stuff like that.
That's a really interesting thought. So in Florida, you're looking as an investor at the trade-off. You'll take a lower cap rate in favor of appreciation. So while it might not cash flows so much on the longer view, the investment will pay off better.
Yes. I mean, then you're also able to, there's going to be a different strategy. You're able to refinance it down the road and pull out some money. Where in an area that's kind of stagnant, like parts of the Northeast, it's not really a viable, you're kind of making your money when you buy in the sense of just hoping that you're going to do a little bit of work to it. The value add model really isn't the best model when you're in a stagnant market. The value add model is more for a growing market. If you're in a stagnant market, you really just have to get a better price, and you have to buy something that's really mismanaged. And, that's something that you can use in an up, down, sideways market. And that's something, too, that we look down here for is mismanagement always. You're buying from owners that are not as savvy, I guess, as you will be when you own it. And that's where you say you can kind of trim it here and push this here and make a better return.
Charles, you've had the benefit now of, years of experience on the apartment side. And a lot of our listeners either are just getting started or want to get started into the multifamily arena. What are some of the items now with this experience that you've gained over the years to be able to explain to people, like, what are the items they don't think about? What are some of the mistakes, the key mistakes that typically they make that could be pretty drastic or deleterious to the cap rate or the return on the property?
I think make sure when you're buying property, you buy it in a good area, buy it in a good neighborhood. I mean, real estate can change by block, and especially it's no difference in Florida. And it's something that make sure you buy in a good area, and it's going to be something, quiet streets, stuff like this, that is actually going to have tenants are going to be drawn to it. The other thing, too, is that I got involved on my first multifamily, and it was a little bit more of a heavy lift, heavy renovation, more than I should have been involved with. And I was lucky to have my dad there mentoring me with it and finding contractors I need and stuff like this. But go into a property, have the fixed long-term debt, very important on whatever you're doing. Make sure your term on your debt is at least twice as long as your hold period. Make sure you have reserves. And even if you're buying a 1 to 4 unit multifamily that you're getting, you have several months put aside of your mortgage interest mortgage principal interest, taxes and insurance put aside, and then also have a reserve fund for unexpected issues. And make sure if you've never priced a property or priced a renovation, just know that there's going to be a lot more things that are going to go wrong than you think. And just make sure you put the money aside for it. And if you're ready for it, it's going to be a lesson that can't be taught by any type of YouTube, podcast, or book when you actually do it. And you'll learn so much more and keep track of your mistakes. And on your second property, you'll start really fine-tuning your process little by little.
So in terms of mitigating risk when you're investing in real estate, besides the factors that you mentioned, what other things should investors be cognizant about?
To mitigate risk, it's really buy a property that, for your first property, something like I said, that's not really too much of a heavy lift. Buy something that has a good occupancy already. And these are great ways of mitigating risk because if you already have tenants that are paying. And when you're buying multifamily, you should be doing, even if it's on smaller multifamily, and I know it's not a normal thing on smaller multifamily, like a lease audit and find out who you're inheriting with the property. And that's a great way of mitigating risk. Make sure when you're doing your due diligence, pay a contractor whatever they want, have them come in and tell you what's wrong with it, and have a plumber come in, have a HVAC person come in, have a roof inspector, building inspector, have these different people. And usually you can have one person that'll do many of those things, but you don't want to cut in corners when you're checking out a property, when you're inspecting a property. You want to make sure that your title company's good. They're doing that. You're not having any other issues. There's not open permits when you're buying a property. And you want to check off all these boxes when you're buying a property, no matter how small it is, because these are all things that are just going to come back and bite you at the end. And it's like with small commercial stuff, we always do like a phase 1, environmental report, no matter what size it is, even if we're buying it direct from an owner, because you just don't know what's on that property. And it's usually something that's required by your lender. But if you don't have a lender, if you're buying it in cash, or if you're buying it and the person's holding paper, the seller, that's something that you still want to go through, and you don't want to leave any stone unturned.
Let's talk a little bit about maintenance. This can be a real bugaboo for some folks, and there's a scalability aspect to it. If you get so many units, well, then you can have full-time maintenance staff. But where are you, Charles, and then how are you managing your maintenance issues at your properties?
So the easiest way, and I think why people are drawn to buying larger properties, is because it's kind of a turnkey scale model, where if you're buying something, and usually it's 100 units, you're going to have one admin person per 100 units and one handyman. And you can really have it make sense for full time when you're getting over that 60 units. So depending on the investor's strategy, it's really that when you're starting out, you kind of want to find the property manager that's going to fit with your properties. They know the area, they know the class of property, which means they know the tenants that you're going to be renting to, and they can work with them, and they have worked with them. And then the other thing too is that how are you going to manage it? Are you going to be using the property manager's handyman, or you have your own contact as a handyman, which is kind of difficult to keep a good part-time handyman. So it's kind of best to be utilizing the property management companies on a smaller scale, but then have like a plan where, hey, when I hit this many units, this is what I can do. And you can start kind of outsourcing certain things little by little and not having your management company hold control of it, which means that you might be able to get a better price, where you might have a realtor that you have a deal with and say, hey, you rent all my apartments, and you're going to, I'm going to pay per unit this amount. So like up in Connecticut with my property manager up there, I pay a flat $250 for every rental. And he has one real estate agent that rents thousands of apartments for him. And that's the deal that he has with him. So it's something where now I can tap into that, because I wouldn't be able to get that. I'd probably be paying 1 month of rent, at least a half a month of rent for that. So that's a scalability factor. And that's kind of that you can tap into. The other thing too is that once you get to a certain level, there's going to be a lot of tasks that you don't want to take care of. So when I have an eviction happening with one of our properties, it gets passed directly from the property manager to the attorney, right? If it goes past that certain date, they don't have to check with me and say, hey, Charles, we're doing this. This is already gone, and this is, they tell me after it's happening, right? Mm-hmm. You can now utilize virtual assistants for certain things, like when you're working with marketing of the properties. When we're doing properties, when I'm properties I own 100% or with partners, I have the property managers reach out to me and tell me when there's vacancies. And not that I don't trust them, but it allows me just a little bit more control. And then I can just pass a set listing I have to one of my VAs to post it. And they'll post it all over your normal, Zillow and all those websites, Craigslist. And then I can know that I'm getting good deal flow that's coming in, and I'm not getting like a secondhand rental deal flow from the property manager that says, somebody calls in and goes, I want to rent the 2-bedroom, and I'm at the bottom of the list for the properties they're showing. Whereas if they call in and go, hey, 123 Main Street, I see this ad here. For $1,100, this is what I want to rent. Now I'm at the top of the list because they're calling for that property. And not that we're taking any calls, we'll have that all sent to the property manager, but it gives you another layer of control. So you know exactly what's happening in the property. You know how long it took for a turn because you know when it was vacant, you know when it was ready. And it's a little check you can do on your property managers. And it allows you to, it's a scalability model too, because now I can just pass it off and I say, take care of that, rent that. And it's not something I have to take care of afterwards. And so everybody kind of has their own plan with their property manager of how in-depth or how much contact they want with them. Is it over $500? There's an expense, they call them. If not, and you just set those thresholds with your property manager. And obviously, you can start raising it as you become more and more comfortable with them. And it might start off at $500. And it might turn into $1,500 in 2 years, right? Where, hey, you're just calling me for hey, there's a serious issue with this air handler over here.
Yeah, I guess by being proactive, it makes sense. And putting your property out there, you never make up a month that you lose while the property's vacant. So just getting a little bit of a heads up and giving your property manager extra ammunition and ability to take calls, it really pays off.
Yep, for sure. And the other thing too is you're going to do a lot more aggressive of a marketing campaign if you have it all set. Where, hey, you have my logins to Zillow and all these other things, and hot pads and all this stuff. So you're going to log in, and it's already preset there for this type of unit. Post it, and then we're all set. And then when I send you a message on Slack, take it off. And that's that. And now there's accountability too. It's not like, hey, when's this going to rent? When was this ready? Now they kind of have a little bit more. Hey, he's asking about this. It just was vacant on Friday. He's asking if it's going to be ready by next Friday because we said it was going to be pretty light turn, just cleaning and painting. And you kind of keep them under your thumb a little bit. And it's your property, but they're running it for you. So it's a very delicate kind of balance where it's how much of my nose is in it and how much of my hands are in it too, without crossing the line where you're like, listen, do you want to manage it yourself or not, kind of a thing.
So you had mentioned about virtual assistants and some other things that would increase efficiency. What else can you suggest perhaps that might help with scalability of the business? Because I think that's a big mistake that a lot of folks make is they feel like they can do it all, but they can't. You just can't. You're going to plateau. There's going to be a limit in terms of what you're capable of doing yourself. So what are some other scalability suggestions you might have for our listeners?
I would say find out what you're good at and find out what you like doing. So I like doing the actual marketing aspect of just marketing in general. So that's why we'll take that, and that's a way that we can keep the property manager under our thumb. But the other thing too is that depending on what you do, if you're investing in real estate for the first time, you probably have some sort of other W-2 or other self-employed income business that you're running. And you kind of want to, this is a mistake I made. You were doing stupid things, changing faucets and all this stuff. What I should have been doing and what I did at the end was make a list and say, hey, this property, these are the things that are wrong. I've got about 5 hours worth of work there. Send over the handyman. These are stuff that's not pertinent. Send them over there and tell them, hey, faucet has to be changed over here and blinds have to be changed over here and this, and you keep them there for a whole afternoon. And now you have, you're not doing it. You're just kind of facilitating it. Right. And have someone mow lawn. And, once you get, the thing is when you get more property, especially if you're strategic and you're buying in like the same area, which you should be if you're buying smaller property, so you get some sort of scale. And, you're paying $30 to mow a lawn, and now you get 3 properties, and now you can get that down to 25, right? And your property manager goes, hey, I'm not going to charge you 7% anymore. You have over 30 units. I'm going to charge you 6% or whatever it is, right? And you go to a different HVAC company and say, hey, I'm gonna, this is what I normally have to do, and can you get me a better price? And now my property manager will call you when there's an issue, not this other person. Or, all these different things that you can do when you're scaling to kind of set it up and have kind of a protocol for your property manager and say, I don't want you to call me when there's a problem that's, a new water heater for this property. Just call this plumber. He knows me. You can cut him the check directly and just let me know then, right? Just send me a copy of the invoice and copy of everything. And then you can say, wow, that got expensive. That wasn't what I told this guy before, and I have to have a call with him, or perfect. And it's running fine. And, so it's kind of utilizing other people that you're paying for and bringing other people that you might not be the best person for, changing flaps and toilets and stuff like this. Get that all outsourced right away. Find a good handyman if you're a small operation right away in your area that can do this. And then, you don't want to be painting apartments. I did that stuff for many years. It was terrible. You don't want to be doing any of that stuff. And I should have just had someone come in, pay him $500, paint the whole thing or the rooms that need to be done, pay their girlfriend to come in and clean the apartment and have it rented and not waste any time, and just show up, sign leases, and give keys and get money.
That's what you get interns for, Charles. That's, they
Yeah, I was going to ask you, is it possible for people to start investing when they have a full-time job? But you addressed many of that with this, but those same factors really on scalability have to be taken into account even when you're not doing it part-time, that you just have other people do the grunt work and focus on what you're good at.
Yeah, exactly. And especially if you're buying and you actually, there's some people that get in that don't have that much money, and they might be buying smaller properties and doing more of it themselves. And when you might have people that have more income more money that they can invest into a property, they might be able to buy a bigger property, have a property manager take care of more of it, and have more of a passive investment, because you can now have more of a little bit of a scale on it versus someone that's like, I got to take all the, the management fees are going to kill me. I've got to take care of these calls. So it's knowing that going in, what you're signing up for, and make sure that your job, if you have a 9 to 5 and you can't pick up a phone call during it, this is going to be very difficult for you.
Yeah. So, Charles, one of the things in this show, in the Invest Florida podcast, that we're proud of is the way people, and they tell us how they've helped each other and actually do deals together. So if there are people out there and are thinking about getting involved in investing and real estate, what would you be looking for from them, or what could they be looking for from you? How could you help each other?
It's a little difficult now with 2020 and now with 2021. We used to do a lot more like local meetups and going there, which are fantastic. And I've met, even through your guys' meetup in Tampa, I've met fantastic people through it, and people I've worked with before and done deals with. And it's a lot of networking. Real estate it's relationships and it's access to capital, and that's really what it comes down to. And if you can really maximize those, you have a competitive advantage against other competitors, other people that you're trying to buy properties from. Because if you can source capital somewhere, if you're able to, hey, I've got a lender that will do a better deal than what this guy's got a lender for. I've got a property manager that focuses in that neighborhood that I met. These things that most people don't have access to, and that's going to give you another step up, an advantage. And maybe you can sharpen your pencil a little bit and pay a little bit more for the property because, you know what? I've got this other thing that guy doesn't have that I'm bidding against. And so I would say a lot of networking and kind of filling out. If you're a more analytical person, find someone that's more outgoing, and vice versa. And really, that's the way you're going to be able to really scale it. And obviously, you can do everything and have a small little portfolio, pay it off, and retire just how you'd like to. But if you really want to build a portfolio and build an investment company, at some point you're going to have to bring in other partners, equity partners with you that are working together collectively on what they're best at.
Talk to us a little bit about debt, Charles. Are you doing traditional bank? Are you doing the agency debt, or how's that working?
Normally we do agency debt, and what we're doing is no less than 10-year terms, and that's they're non-recourse, and that's really what we're focusing on when we're buying properties that we're doing value adds in. For smaller commercial multifamily properties, so 5+ units with loans under $1 million, we're going to utilize commercial banks, and that's something that usually when you're going to those lenders, you can only get 5 and 10 year terms. And if you really dig your heels in and you really do the research, I have some 25-year fully amortizing commercial debt from banks with special programs that they have. So you can kind of figure out what your goal is when you're doing it. I'm a real big fan of long-term debt. I feel it really mitigates your risk when you're going into investing. And I mean, you just don't know, especially with COVID. Now it's just if you can get financing from these different lenders, but just try to call around, especially if you're dealing with smaller properties. A broker's good, but nothing's better than spending an afternoon and finding a list of small banks and credit unions within, say, a 45-minute drive of your property and emailing them with what you're looking for or giving them a call. And you'll find some very interesting products and services that they're going to offer. And that's going to be something that you might be able to utilize. And it's interesting. Most of them are going to push you on the 5-year and 10-year terms, or a 10-year term that readjusts in 5 years. But you can find some, if you're diligent, you can find better financing that might be more to your risk level.
Yeah, it's always interesting with banks because they have their sweet spot. One bank might be full up in one area and will steer you in one direction, whereas another one will be much more open.
Exactly. It's definitely.
Talk to us a little about finding deals. I mean, you said you did some mailing. Where else are you sourcing your deals?
So one of our partners that we work with in Tampa, they have some very good relationships with other brokers. And instead of kind of reinventing the wheel, and when there's deals that they pass us deals that they have, and we kind of see where we can partner together on them. And then we found that out to be probably the most efficient way, where we're not going out and talking to the same brokers and the same people, really just kind of riding on their coattails. They bring something to us and say, we kind of figure out what our roles are going to be there, how much money needs to be raised, what we need to close on the property, what roles, who's taking care of what. Direct to owner marketing is another great avenue. And I know it's much more, I do know it's much more difficult. And you'll probably hear from people that it's not really efficient for larger multifamily. So say 50 plus units, which could be true. And it is true for the most part, but it doesn't mean, I get calls back regularly from people with 40 plus unit properties. Not that I've bought them before, but they're still returning our calls. I have them in our CRM. I follow up with them every 3 to 4 months if they're selling anything. Because someone that owns a 12 unit, they probably have some quads, right? Yeah. And someone that owns a 50 unit probably has an 18 unit and a 12 unit too that you didn't find or they didn't respond back to you on. So it's really interesting how small commercial real estate is, and how kind of few properties there are. You feel there's so many properties out there, and there's really not that many. And a lot of them are owned by the same people. So really, that's how we're sourcing. It's mainly through brokers for larger stuff. And then on smaller stuff, we like to go direct to owner. And really there, the broker fee, and you can save that. And that's an old adage. But the main thing is that if we can negotiate out creative financing with the seller, that's the best. I don't mind. I'll pay the broker fee myself out of the pocket if I can go in with half a down payment. Versus, when you're going in for a down payment and then after you pay your broker and after you pay more points and an origination fee and this, that, and the other thing, I'm at, 5% more higher on my down payment. So if I can go in there and do a 15% down payment, right, without any junk fees, that's going to be something that's going to just boost our cash on cash so high compared to someone else that's going there and only using a traditional credit union or a local bank that's going to say 25% plus 2 points plus a 1% here and 2% here, and our overnight FedEx fees and a wire fee and every fee, and that's something you can avoid when you build rapport direct to owners.
So Charles, how can people contact you to get more information?
Yeah, like what are you working on? Let's talk a little bit about that too, like what you're working on in terms with investors and whatnot.
So as being the Invest Florida show, we really focus on the majority of our doors are in Florida. But we work with a couple other partners. And over the last month, we've been underwriting deals from obviously Florida, Atlanta, Alabama, Arkansas, Tulsa, Dallas. And where we have people on the ground there, I have 2 other partners in the Southeast that will source us deals, and then we can partner on them potentially. And that's something that when we're looking at deals, and like I said, it's usually 75 plus units. and usually $5 million plus purchase price is what we're looking for syndications in areas where we can do some work, and we're really looking for properties that are mismanaged. And I think that's really the goal. And because the mismanagement, the value add is always great, and you'll hear that on every podcast. But I feel, especially when I talk to friends that are in private equity, and they always kind of chuckle when they hear the value add model, because it's not in every market kind of thing. You can't do a value add, I think, efficiently in every port of this market cycle. And it's something that if you find properties and you focus on properties that are mismanaged, and that's most easily found by like mom and pop run and own properties. Sure. That's where you're going to be able to, because I can always trim some fat here. I can always bring in someone that's more efficient. For example, we just bought a property in Tampa a few months back, and it was we did 90 units. And it was a 68 unit and a 22 unit. The 68 unit was owned by a more professional group of Harvard alumni guys that I bought a few years back. We bought it. It was mostly stabilized. We then bought a 22 unit building about a block away and put it together as one syndication portfolio. And we bought that, and the guy owning the property was paying his now ex-son-in-law 15% management fee.
Oh my gosh.
And we have a manager. Exactly, right. Now you know why it's the ex-son-in-law. And he was like, hey, I can stay on if you want.
Maybe he had an ugly daughter, and that was the fee. That was the going rate.
Oh, God. I thought we were going to get through the show without a misogynistic comment.
But you can find it. I mean, that was an on-market deal too. So you can find these things, and no matter what's happening, if we couldn't raise rents for 3 years in Tampa, I can still go in there and bring that to our management company that's going to charge us, kind of like almost a fifth of that, and trim fat there. And the property was terribly managed, and we're still working through that now. But that's something that in any market, any part of the market cycle, you're going to be able to increase NOI one way or another. And that's the real thing. It's like when you're selling a property through a real estate agent, and you kind of ask, hey, what's your goal of selling this property if you can't sell it at $500,000 without lowering the price, right? And the same thing is, when you're going to dealing with a partner or you're investing passively in a deal, you go to the operator. What else do you have up your sleeve other than raising rents? What else can you do to boost NOI without raising rents? And most people just kind of look dumbfounded. And it's something that if you're fixing mismanaged properties and you have kind of a clear business plan to doing that, that's going to be a huge competitive advantage, because you can then pick that up any type of part of the cycle.
So you do mostly syndication. So there's people doing passive investing with you, and then perhaps there's some hands-on investing. Why don't you tell people how they can get in touch with you, and what kind of deals that you might be able to work together on?
Yeah, thanks, Eric. So if you're interested in investing passively or actively in real estate, you can set up a free 30-minute strategy call with me. Just go to schedulecharles.com and set up a call. We can talk about whatever you'd like to do, where you are now and where you're going. And my company is Harborside Partners, and all those links will be, that page goes right to my personal page, charlescarillo.com. So you can find all my information right there, and all the links to projects we have. Reach out, and I'd love to talk to you.
Awesome. Charles, really appreciate the time that you invested with us today. Stephen, anything else before we let Charles go?
No, Charles, thanks for your time, and we'll talk to you soon.
Thanks, Eric and Stephen. I always love listening to your show, so looking forward to connecting with you guys in the near future.
And that was Charles Carillo talking multifamily investing, a syndicator here in St. Pete, but he's working all over the state and around the country. Stephen, what were your thoughts?
Well, the one point that Charles made that I thought was really interesting was, we're working in the Florida market at low cap rates, and you think, well, why wouldn't I work in other states? I can get a higher cap rate and a better cash flow, but in Florida, you've got the appreciation because of the population growth and the job growth. So at the end of the day, when you do your return on investment and you sell the property, the appreciation is going to beat out the cash flow. So it just was an interesting point that I thought was really people ought to take into consideration.
Yeah, I mean, these syndicators, they're interesting because he's got a lot of stuff going on, and he's out turning over a lot of stones, and was able to give pretty good overview of how he's running his business and what he's doing here in the market. So it's great to have Charles on. Stephen, Charles was a great guest. Where can we find other great guests for the Invest Florida show?
The one place to go is our website, www.investfloridashow.com, where you can download and listen to all the past shows that we've had. Also, stay current. Listen while you're live and listen on your mobile device. Just download the app from the various app stores.
Guys, as always, we appreciate the time that you invest with us each and every episode. And until next time, hasta la vista.
You've just listened to the Invest Florida podcast with Eric Odum and Stephen Silverman. Join us every week for actionable real estate investment ideas, and of course, visit our website at www.investfloridashow.com for more shows and tips on how to earn a cash flow in the real estate market in Florida. While hosts and producers of the Invest Florida show have no reason to doubt the validity of comments of our guests, we do not warranty their accuracy. Please check with your legal, financial, and tax advisors before entering into any investment. Returns will vary from person to person and deal to deal based on unique circumstances. All information expressed in this show is for educational purposes only. Opinions of the guests are not necessarily shared by the hosts and producers of the Invest Florida show.